One Fed member wants a hike right now, while the data just told everyone else inflation is cooling fast. Thursday's PPI report came in flat for July, cooling the annual rate from 5.5% to 4.7%. Stocks jumped, yields slid, and traders trimmed Fed hike bets. But one currency pair moves more than any other on this. Stick with me, because by the end you'll know exactly which pair and how traders are thinking about playing it. Here's why this matters for currencies, not just stocks. PPI is a leading signal for core PCE, the Fed's favorite inflation gauge. Citigroup now expects core PCE near 3.2% year over year, lower than earlier forecasts. Lower inflation odds mean less need for more hikes, and that shrinks the dollar's rate advantage. The 10-year Treasury yield dipped to 4.61% Thursday, the direct transmission line into FX. But it's not unanimous. Cleveland Fed's Beth Hammack still wants an immediate hike. That split between soft data and hawkish dissent is exactly what creates volatility, not a clean trend. EUR to USD and GBP to USD both get modest support as the rate gap versus the dollar narrows. A steady Bank of England alongside a dovish Fed could widen the case for sterling upside into autumn. USD to JPY is the most sensitive pair here, tied structurally to Treasury yields for years. Falling yields shrink the yield gap that's kept the dollar elevated against the yen, and Japan is already uneasy about a weak currency. Meanwhile, risk-on moves in stocks tend to lift the Aussie and the loonie alongside softer yields. Carry traders short euro to USD or long USD to JPY now face squeeze risk if disinflation is confirmed. But energy costs are still elevated, real yields remain high, and the 30-year Treasury auction cleared at 5.216%, the highest since 2001. That's not a market fully convinced the Fed is done. The reveal is almost here, and it comes with a real catch. USD to JPY is the pair to watch. It's the most exposed to falling yields and the most likely to move hard on the next data print. Traders leaning into yen strength are watching the 10-year yield. A break below 4.60% builds the case. A bounce above 4.75% kills it. But real yield staying elevated is the caveat that could cap any dollar weakness. So this is a repricing, not a confirmed reversal. Read the full analysis on edge-forex.com. Link is in the description.